An indicator that we've looked at for many of the best franchises in terms of your return on investment across different categories is comparing the average sales, AUV, average unit volume, to the investment point. So what is that ratio? Sales to investment ratio. Say you have a Domino's pizza doing $1 million in sales and it costs you $300,000 to open. That would be a 10-to-3 ratio, so 3.33. And you can compare that number to a Blaze Pizza, which would be more like a 1.5, 1.6, or a Little Caesars that would be below 2, or a Pizza Hut that will be below 2. So in terms of sales to your investment amount, a lot of the top brands on Vetted Biz, we have that data so you can see what the average sales are and then look at the midpoint investment level to see what the sales to investment ratio is, and then using that number to compare apples to apples. So if you look at a home care business, the investment's pretty low for a senior care business, a home care business where it might be $150K and the average unit volume is $1 million or $1.5 million. So that sales to investment ratio for that set home care franchise brand might be 10, where it doesn't make sense to compare that 10 to a Domino's pizza, which has a sales to investment ratio of say 3. You want to compare the sales to investment ratio across brands of the same industry, but also it can be a red flag when you have a sales to investment ratio below 1. So we've seen that with some spa businesses where there's a big build out and the sales are less than the investment amount to open up. Generally, that's a big red flag. I haven't really seen many franchises where the cost to open up the business is higher than the average sales on an annual basis. So if it costs you $2 million to open up a McDonald's and it does $3.4 million in sales, it's above that 1-to-1 ratio. But on the other hand, say it expects to cost $500,000 to open up a Subway and they're doing sales less than $500,000, that's below the 1-to-1 ratio, and that's a red flag when you look at franchises. Generally, you're going to want to see above 2-to-1 sales to the investment amount. Again, look industry to industry because some industries like home care have a super high sales to investment ratio, as well as some industries like real estate brokerage have a very low profit margin because so much of those sales get passed on to the sales associates and the owner of the real estate brokerage firm is left with very little of the money, but it's a very high sales number. The amount of profits that you get from the business is going to matter at the end of the day. Sales is largely a vanity metric, but when you don't have access to the profit margins, the earnings for brand to brand, and we do have that for thousands of brands on Vetted Biz, but if you don't have that information, comparing the sales is one of the metrics that you can look at when you're looking across similar brands in the same industry. I hope you found this informational. Again, look at the sales to investment ratio before you invest in a franchise, especially when comparing different franchise brands in the same industry.